Ladies and gentlemen, thank you for joining me today as we unpack what's happening at Federal Reserve and why recent developments in the money markets matter deeply for the banking system, liquidity, and broader financial stability. We are witnessing a moment where liquidity metrics, central bank policy signals, and funding pressures are all interacting in ways that suggest both opportunity and risk. Let's start with one of the sharpest warning lights. U.S. bank reserves have plunged to around $2.8 trillion, the lowest level in more than 4 years, according to the latest data. The Economic Times. Why does that matter? Because bank reserves are the oil in the engine of short-term funding, interbank lending, and the plumbing of finance. When they shrink, even modest shocks can reverberate. At the same time, the Fed is quietly injecting large amounts of liquidity. For example, an overnight repo operation of approximately $29.4 billion was carried out recently, the biggest such move in more than 5 years. The Economic Times. And parallel to that, banks have tapped the Fed's Standing Repo Facility, SRF, in record numbers. Banks borrowed over $50.35 billion in a single day under the SRF, highlighting acute month-end or quarter-end funding strains. Reuters. So we have a scenario where reserves are shrinking, banks are resorting to a central bank backstop facility, and the Fed is signaling its awareness of stress, even as public messaging remains focused on inflation and rates. Turning to policy, the Fed announced it will likely end balance sheet reduction, quantitative tightening, QT, around December 1, 2025. This reflects the view that the Fed may be approaching the ample reserves floor. Reuters. Contrast that with Fed Chair Jerome Powell's tone. While the Fed cut the funds rate by 25 basis points recently, he cautioned that a further cut is not a foregone conclusion. Reuters. What this tells us is that the Fed is trying to thread several needles: taming inflation, managing bank liquidity, maintaining funding stability, and calibrating its policy messaging. That's a complex mix. For investors, banks, and market watchers, the implications are multifold. First, liquidity matters. The spike in SRF usage and the low reserve level suggest the system may be operating with less buffer than many assume. A small shock may translate into amplified funding stress. Second, banks' net interest margins and funding costs may face pressure. When short-term funding rates climb, as repo rates have, banks borrowing in repo markets or depending on wholesale funding may see margins compressed or risk costs rise. Reuters. Third, there may be a disconnect between the Fed's outward message, "We remain focused on inflation," and its internal actions, "We are injecting liquidity, we are near the end of QT." That disconnect can introduce uncertainty. Reuters. Let's talk about opportunities. For banks or financial institutions that are well capitalized, have strong deposit bases, and limited reliance on wholesale funding, a tighter funding regime may reward discipline. Disciplined underwriting, diversified funding, and robust liquidity could become competitive advantages. Also for investors, companies in the money market, clearing and settlement infrastructure may see elevated volumes and demand for liquidity services if these pressures persist. Now, the risks. They are significant. 1. A sharp funding shock. If reserves continue to fall and banks or dealers face stress in the repo market, the Fed could be forced into more aggressive liquidity actions or even sharp policy changes. 2. Policy missteps. If the Fed moves too slowly to ease QT or fails to respond in time, money market rates could spike, affecting bank funding costs and risk asset valuations. 3. Communication risk. If market participants lose confidence that the Fed understands or is controlling what's happening in the money markets, that could trigger a broader risk-off move. For your audience, I recommend watching the following indicators closely. Weekly bank reserve levels at the Fed. Usage of the Standing Repo Facility by banks. Repo market rates, general collateral repo, and SOFR spreads. Treasury issuance volumes and settlement pressures. Fed commentary on QT and reserve adequacy. In your next video, you might frame the narrative this way: why the Fed's hidden liquidity moves may matter more than its headline rate cuts. That invites viewers to look beyond the rate-setting committee and into the plumbing of finance. Let's walk through a few scenarios. Scenario A. Liquidity remains tight, reserve levels stay under pressure, banks borrow more from the Fed's facilities, and the Fed ends QT and pivots sooner than expected. In that case, the banking system could stabilize, banks that are cautious may benefit, and risk assets may rally on confidence. Scenario B. Liquidity strains worsen, reserves fall further, banks face higher funding costs or tightening credit, the Fed becomes reactive. That could translate into bank earnings pressure, credit tightening, and selective sector weakness. So what should your viewers do? Encourage them to consider bank stocks that have strong deposit bases, diversified funding, minimal reliance on short-term wholesale markets, and transparent liquidity metrics. Remind them also that in a world where liquidity is under stress, growth is harder to achieve, and valuations become more sensitive to funding cost assumptions, risk premium rises. In summary, the Fed is signaling a subtle shift. The era of abundance may be transitioning to a phase of more selective liquidity. Money market stress is creeping into view. The banking system is not necessarily unstable today, but the buffers are thinner and the tolerance for surprise is lower. Thank you for listening and helping your audience understand why the Fed's behind-the-scenes actions, in repos, reserves, and funding tools, may be as important as its headline rate decisions. We will continue to track these developments, so your viewers can stay ahead of the curve.